watch Dave Ramsey go off on Social Security.
Only the government could figure out a way to talk everyone into having something removed from their check that they make a negative 4% on, and everybody fights to keep it in place. And it becomes a political icon. Only in the United States government could they figure out a way to make that crap work. And you guys all just, mess with Social Security.
Let me say this. I have a ton of respect for Dave Ramsey. His advice has helped many, many people make smarter financial decisions. And his book, The Total Money Makeover, was a great read early in my career as a financial advisor. But like many things in life, I don't believe in following anyone's advice blindly. Over 24 years of helping families manage wealth has taught me that his principles work best when applied thoughtfully, and depending on your personal finances, might not even be the best for your situation. After watching his take in the video, "When is the best time to collect Social Security?" Dave Ramsey rant, I had to get a few things off my chest. So let's break down his arguments together and see what makes sense.
Hi, Tracy. Welcome to the Dave Ramsey Show.
Hey, Dave.
What's up?
Thank you very much. Really appreciate the opportunity.
Sure.
I'm 61 years old, and I keep getting these letters from Social Security wanting to know what I want to do. And, I'm still working. Mm-hmm. I'm on baby step 7. Mm-hmm. I am married. Mm-hmm. And, I don't know, when is the best time to take advantage of that fantastic program?
I sense sarcasm, Tracy.
You would sense correctly.
All right, so Tracy's question, what's the ideal age to file for Social Security, is a simple but common question and is hands down one of the most frequent questions that I get from clients. Now, when people ask this, they're really often asking, when do I file so that I can extract the maximum amount from the Social Security Administration? You've been paying into the system all these years. How do you get the most out of it? What are the pros and cons of taking Social Security at different ages? But as we get into this, you'll see that the answer isn't the same for everyone. What's important as a financial planner are the details of the situation. The caller, a 61-year-old who seems financially stable and is following Ramsey's baby steps, is debt-free, he's married, and still working and saving money. So let's dive deeper into his situation and analyze it step by step. Let's keep watching.
Well, I mean, the trick to knowing when to take Social Security is to know when you're going to die. And once you got that figured out, then you can calculate it precisely. Okay. Obviously, the longer you live, the better it is mathematically to take it later, because you're going to get a bigger check for a longer period of time. Okay.
Can I throw something else in there?
Sure.
I was actually intending to, I don't need it, so I was intending to invest 100% of it. However, then I found out that I don't get the full amount if I start early. So go ahead. I'm sorry.
Right. Yeah, you don't. And the later you start, whether it's 62 all the way up to 70, the later you start, every year you would get more.
Okay, so here's the key part to being a good financial planner. You need to be able to listen and listen well. It seems like Dave already had his answer ready and missed a key point here. Tracy, the caller, mentioned that he wanted to start collecting Social Security early and invest the money because he didn't need to use it yet. But he learned that collecting earlier while he is still working would reduce his benefits even further. Dave explained that by filing early, he would get a smaller check, but the caller is actually concerned about the earnings limit. If you are working and collect Social Security before your full retirement age, which is 67 for most people watching this, your benefit is potentially reduced even further. In 2025, if you are 62 to 66 years old and earn over $23,400 in employment income, in my opinion, it does not make sense to file early and invest the benefits. Your Social Security benefits are going to be significantly reduced. It's actually a quirk that was recently brought up on the campaign trail that can disincentivize people in their early 60s from working. How much can you earn and still get benefits? In 2025, if you are under your full retirement age, the Social Security Administration reduces your benefit $1 for every $2 that you earn above the annual limit. That limit, as I said, is $23,400. And in the year of your full retirement age, they reduce your benefit by $1 for every $3 that you earn above $62,160 until the month you reach retirement age. So let's get back to Tracy. He's thinking about filing at age 62 while still working. The caller never said what his benefit is and what his income is. If his income from working is less than $23,400, then his benefit is not reduced and he can think about investing the money. But let's assume he has a $2,500 per month benefit at age 62 or $30K per year. Let's also assume that Tracy is making $80,000 working full-time. He makes $56,600 more than the limit. Social Security would withhold $28,300 of the benefits, $1 for every $2 that you earn over the limit, meaning his $30,000 benefit would only be $1,700. The payment is significantly reduced for Tracy in each year that he has this income until he reaches his full retirement age. Then, at FRA, the Social Security Administration increases your monthly check for the remainder of your life. And those benefits that were withheld while you were working and claiming from 62 to 67 are not permanently lost. They're added to your monthly benefit once you reach your full retirement age. Well, that changes things quite a bit. Why would you file early and hope to invest it on your own when you lose over 90% of your benefit? Claiming early and investing the funds would only potentially work if your employment income is below the annual threshold. So the next question is, what type of income counts towards reducing your benefit? Well, if you work for someone else, only your wages count. If you're self-employed, they count your net earnings after your business expense deductions. They do not count investment earnings, interest, pension or annuity income, or capital gains.
If you run some math out, you can actually run the calculations on their site. It's fairly easy to do. If you run the math out in your situation and you say, okay, I could take it at 66 or 67 and I would get this amount, okay? And if I took it at 62, I'm going to get a different amount, X versus Y. You follow me? And the difference in those could be made up almost every time. You can run the numbers on it by taking every dollar from 62 to 66 that you get and put it in a good investment. The investment returns will give you greater than the difference for the rest of your life.
Now, Dave is getting to the heart of the real question here. It's not just about the best age to file for Social Security. The real question is whether it's better to file at 62 and invest the money or wait until full retirement age. For this argument, let's assume that the caller is not working anymore and is just deciding whether to claim early and invest the proceeds. Let's break it down. As you know, waiting until your full retirement age means that you'll receive a higher monthly benefit than if you file early. For example, going back to Tracy, if at your full retirement age of 67, your benefit is $3,571 a month, filing at 62 would reduce that by about 30% to $2,500 a month. Dave's argument is that the difference can almost always be made up by investing the money. In this case, if you take Tracy's hypothetical $2,500 monthly benefit from age 62 to 66 and invest it wisely, the returns could potentially make up for the lower benefit amount in the long run. He's saying that the growth in your investment account could be enough to cover the $1,000 monthly gap between the reduced benefit at 62 and the full benefit at age 66. So let's test this. Tracy's full retirement age benefit is $3,571. If he files at 62, his benefit would be reduced to around $2,500 a month. That is a difference of $1,071. The question is, can investing the $2,500 per month from age 62 to 66 generate enough growth to make up for the $1,071 monthly difference and keep doing so for the rest of their life? To do this correctly, we also need to factor in the annual cost of living adjustments, or COLA, as they'll impact both benefit amounts. COLA affects larger numbers more than smaller numbers, amplifying the difference between these two amounts. If at age 62, the reduced benefit is $2,500 and the full retirement benefit at 67 is $3,571, that's a difference of $1,071. Using a conservative 2% annual COLA from 62 to 67 increases the original $2,500 benefit at 62 to around $2,760 per month at 67, and the original $3,571 full benefit to $3,942 per month at age 67. That's a difference of $1,182. You can see the difference gets wider, and that continues every year that you are alive. Well, how long is that? Well, next we got to consider life expectancy. The Social Security Administration's life expectancy calculator shows that a 62-year-old male in 2025 is expected to live until about 84 years, and a female slightly longer. To be fair and to give Dave's argument the best chance of working, let's use a life expectancy of 84. And I already know it. Down in the comments, people are going to talk about how people are not living longer anymore. Well, the reality is that if you reach age 62, your life expectancy is longer. It's just that there's a lot of current talk regarding chronic health conditions and issues with children. But generally, if you've made it to age 62, you're probably going to live to about 84. Now comes the key variable, investment returns. Dave Ramsey often assumes a 12% annual return. So let's start there. Even though as of 2025, the average annual return of the 100% of your money in the S&P 500 is just over 10%, he always assumes you do even better. So let's start there. If Tracy invested the $2,500 a month benefit and the 2% COLA increases from age 62 to 67 with a 12% return, like Dave says, each and every single year, he would accumulate about $210,314 by age 67. Not bad at all. But now at full retirement age, Tracy would need to start withdrawing $1,182 per month from this account to cover the benefit gap from filing early and increase that by inflation over time. By the time Tracy reached 84, their balance wouldn't just stay intact, it would have grown to over $720,000 because of that 12% return each and every single year. This is the scenario that Dave envisions where everything goes perfectly. But what if it doesn't? As a financial advisor, I'm consulted to think about what could go wrong. The stock market doesn't deliver consistent returns, and a few bad years could really impact things, especially if they happen early during retirement withdrawals. And with the recent good performance over the past decade, I don't think it'd be surprising if returns weren't as good moving forward. Let's assume a more modest 5% average return instead of 12%. In this case, from age 62 to 67, the $2,500 per month plus COLA grows to $176,865. Then, as we withdraw money, this portfolio would last 16 years to age 83, basically at life expectancy. That barely succeeds in my opinion, and you must earn 5% each and every single year. This has brought a lot of variability into equation.
So it usually makes sense to take it early if you're going to do what you're going to do, which is invest every bit of it and let it run. Now, taxation comes into play when you're still working. All those other things come into play. You got to look at that and figure out how much you're actually going to net.
All right, here are two keys that you have to remember. You took Social Security early and invested 100% of it. You didn't spend a penny of it, and we didn't assume any taxes on the benefit. You could be taxed on up to 85% of your Social Security income at your marginal tax rate, and you could be taxed on the capital gains from the investment account. So if you're going to file early, you need to have a low enough provisional income to keep your Social Security tax-free, and you need to invest 100% of the money to make it worthwhile.
The basic concept is that you can get a better rate of return than they will pay you by waiting, so that you take the total amount between that 4 years of X number of dollars a month into a good mutual fund. Will then, from the rest of your life, that one account will make you more than enough to cover up the difference between your 66 account and your 62 account, that payment. amount. That's what it amounts to. Plus, when you die, that money that's in that mutual fund is part of your estate. When you die with Social Security, nothing!
Okay, the estate argument overlooks a crucial aspect of Social Security planning: survivor spousal benefits. While it's true that Social Security payments stop when you pass away if you're single, if you're married, the filing decision has lasting implications for your surviving spouse. By claiming early, you're not just reducing your own benefits, you're also lowering your spouse's survivor benefit if they were the lower earner and outlive you. This ripple effect on survivor benefits adds another layer of complexity to the filing decision that goes beyond simple estate planning. Making this choice requires careful consideration of both spouses' financial needs rather than just maximizing what you get from the system in the short term. Are you convinced that claiming Social Security early is the right strategy for you? Or are you still wondering if maybe delaying benefits is really the best strategy? You should check out this video next to learn the ideal time to claim Social Security, age 62 or age 70.